In this video, we're going to talk about psychological levels, which are levels that aren't necessarily evident on the chart, but you really should pay attention to them anyway because they will help you filter out some of the bad trades and get your strike rate up. So as I just said, psychological levels are levels that aren't necessarily evident when you just kind of look at a chart. They aren't support and resistance levels that you've seen price bounce off just now or 5 years ago or whatever. But what they are is that they're levels that the market does pay attention to. Now, they're generally more important in the lower time frames, although you can see the market pay attention to the big levels in some of the larger time frames as well. So the way that we trade these levels is we don't take trades off of them. So we don't take trades bounces or anything like that and treat them as a support and resistance level in that sense. We more use them as a filter to stay out of trade. So if price is approaching some of these levels, then we may decide that actually it's better not to get into the trade at all and not risk anything, because oftentimes the market can bounce at these levels, even if it's kind of like, 10, 20, 30 pips. If you're in a short-term trade, that's enough to take you out of a trade. So if we're looking to get into a trade and we're approaching these levels, depending on the rest of the market condition, we may decide to pass up on that particular trade because we're approaching a psychological level. Now, there are two types of levels that we pay attention to. We pay attention to the round numbers and we pay attention to the daily ranges. The round numbers are ultimately numbers that have a significant psychological impact. Now, these tend to be things like the 00 numbers or the 50s if you're day trading, but ultimately the big candles, so things like 1.5000 is a big number, 1.3200 is a big number, 1.3250 would be a number that you'd be interested in if you were day trading. But those sorts of numbers they're, as I said, they're numbers that you won't necessarily see at first hand from glancing at a chart. But if you look at the way price reacts to them, particularly on the shorter time frames, you'll see that they are numbers that the market pays attention to. And if the market's going to pay attention to it, no matter how short term that actually is, you need to pay attention to it as a trader. So ultimately speaking, what you want to do is you want to try to trade between these numbers. So let's say, for example, you're looking for a long entry at 1.5397. Why not wait for the price to break through 1.5400 and take the trade at like 1.540203, something like that, rather than taking the trade directly into a trouble area, directly into a psychological level, which in the short term may reject the price. By the same token, if you're looking to take profit, and let's use the long example again. So if you're looking to take profit at 1.5455, then maybe possibly it's a better idea to take profit at something like the 1.5445 or the 1.5448. So just before you get to those particular levels. Now, as I said, if you're longer term trading, sometimes you can't pay attention to these levels. Sometimes it just doesn't make any sense because you're always going to be trading into one of those levels. But if you're doing some shorter term trading, things like day trading, it's certainly something that you want to pay attention to. Even if you don't use it all the time, if you're coming up to a particularly big level, it's definitely a good idea just to take a look, take a glance, see what price has done there in the recent past, and decide for yourself whether it's a good trade to take or not. The other type of psychological level that we pay attention to is a daily range. Okay, every pair that you trade is going to have its own characteristics, and ultimately those characteristics dictate the kind of volatility for a pair, so how it moves in a day, but also how far it moves in a particular day. All right, now each pair generally seems to only have a certain distance that it can move on an average day. Now, there will be some days when the pair can move much further, and there will be days when the pair doesn't move that far at all. But on average, you'll find that each pair has its daily range, and the daily range is how far the pair can move from high to low. So, for example, the euro tends to move between, let's say, 100 to 120 pips a day on average. So how do we trade that? Well, ultimately, if we find that we're taking a trade, the euros moved 110 pips for the day, okay, and we know that the daily range is 120 pips, then perhaps we wouldn't look to take that trade because we've only really got 10 pips worth of profit for an average day in the euro. Whereas, for example, we were taking a trade and the euro had only moved 80 pips for the day, and we know that it's got a range of 120 pips or something like that, then we know that we've got 40 pips to play with before the euro on average decides to turn around and go nowhere. Okay, so that's how you trade these levels. You pay attention to them, and much like the round numbers, if you're going to trade into a daily range, so if you're going to trade into the range for the day, as in, you know, the euro's moved 120 pips and the range is 120 pips, then you're better off, more often than not, just leaving the trade and moving on to the next one. So the question then is, how do you calculate the daily range? Well, what we do is we take the last 20 days candles and measure the difference between the high and the low. Okay, the last 20 days, so you'd say yesterday's candle high was 1.3220, yesterday's candle low was 1.3110, and then the difference between that is 110 pips. So then you do that for the last 20 days. You then add all of those values together. Okay, so let's say yesterday's range was 110 pips, the day before was 100 pips, the day before that was 50 pips, the day before that was 150 pips, and so on and so forth. You get all of those numbers, add them all together, and then you would divide them by 20, and that would give you the average for the last 20 days. Of course, if you don't want to do that, another way to do it, another alternative, is to use the indicator, which are available on pretty much every charting platform out there, and that is the ATR, the average true range. Okay, if you apply this indicator to your daily charts and you take the reading off that indicator, that will give you the average true range for whatever period it is that you choose. Now, we're suggesting 20 here, but you could choose 15, you could choose 10, you could choose 40. It's up to you, but 20 seems to be kind of a good number because it gives you about a month's reading worth of the candles. Okay, so the best way to do it in reality is to add the ATR, the average true range indicator, to your charts, to your daily charts that is, and take the reading off of that. Okay, so just a very quick recap. Psychological levels, we've got two that we pay attention to: the round numbers and the daily range. The way that we use them, we don't use them to trade, you know, bouncers off of or anything like that. We use them as a filter to stay out of trades. So if we are approaching a round number or we're approaching the range for that particular day, then we may decide that actually it's not worth the risk and we'll skip this trade and we'll wait till the next trade tomorrow. All right, and that's ultimately how we do it. It's as simple as that. There's not a lot more to it. It's just filtering out the bad trades, filtering out the trades that don't stand as much of a chance of success as those trades which aren't trading into these levels. Okay, so I hope you've enjoyed this video and I look forward to speaking to you on the next one. Take care now.